Let me welcome everyone. Thanks for joining us here at our GTDC IDC channel chat. It's a series that we started a couple of years ago, and we really value the partnership we have with the IDC and appreciate these updates that Loren helps organize. We have a new guest with us today, but before we get started, let me introduce Frank Vitagliano, CEO of the GTDC, just to get us started.
Hi, Kavita. Thank you and welcome everybody, and thanks for joining. So as you can see from the first slide, the three of us, Loren and Susan and I, will host this session. We're happy to be doing it. We'll look at mostly third quarter data. Loren will take us through that. And then Susan, who is the Research VP for Consumption and Financing Strategies, will spend a little bit of time talking about that. We've got one or two GTDC slides. So I just want to make sure everybody knows that our annual event is coming up here in February. So we've got registration now open February 7th and 8th in Oceanside, California, which is right outside San Diego. And we're looking forward to hosting many of you again this year. So go ahead and register for that as soon as you get an opportunity. So what I wanted to make sure everybody was aware of is that on our Knowledge Hub, we have all of the reports, research content that we do, in addition to our podcasts and webinars. And then, occasionally we'll publish a Frank's Insight or a Did You Know? All of that's contained on our Knowledge Hub, and I would encourage you to go ahead and access that for any information. So with that, Loren, I know everybody really joins not to listen to me, but to listen to you talk about what's happened. So let me turn it over to you.
Yeah, thank you so much. Appreciate everybody dialing in, and I think we've got a good set of content here. My focus will be on the IT distribution results, which, as we've done in the past, I think that'll be really interesting. And Susan is going to give us some insight on as-a-service models and how they're trending and where the opportunities are on that. So let me start with the macro environment, as I have in the past. I think this slide kind of kicks us off with what I would say is a little bit of a summary of where we've been. It's a bit pessimistic outlook for 2023. There's been, a lot of discussion about slowing GDP, potential recession, and I think this is a couple of interesting points here are that the North America region has been the most pessimistic. Other regions have been more optimistic, and that Asia's substantially more optimistic, almost 20 points more optimistic since the last time that we spoke. This is actually also a really interesting setup. Here we are in beginning or even mid-October. And so that last slide was expectations for 2023, and there's only 2.5 months left. But if we look at 2024, the outlook is much more optimistic across regions. So you can see that most regions and most of our respondents, this is over 1,000, total looks like it's almost 900 respondents were are much more positive about 2024. And, that's a great sign. I mean, we'll talk a little bit about the factors in a moment that are going to drive that. But not only is this more positive, but we've got much more positive outlook from the last time that we spoke about 3 months ago. So this slide here does a really nice job of breaking down the overall situation. So economic growth has been resilient, especially in the U.S. Risks have not disappeared. So there's, uncertainty about China. There's weakness in Europe. There's geopolitical, there's Ukraine. Now there's Israel. So there are these disruptions. But I think we've mostly moved past the direct pandemic impacts. And now we're into the interest rate impacts and the related political impacts that obviously affect stability and business confidence and so on. Having said that, IT markets have performed pretty close to in line with our expectations. Infrastructure has been more resilient. Devices have been receding from pandemic era surges. And so we'll see that again in some of the other slides. And then as we get into 3, we've got, future drivers of growth. So AI interest has exploded. This fits very well with our expectation that tech development is going to continue, that there's always a new wave that's going to fuel future investment, and that IT spending is going to outperform GDP growth. So, broadly optimistic in terms of tech spending. And then finally, under 4, the business and consumer environment remains is responding to those factors. So businesses are committed to strategic investment. So there's digital transformation, there's AI adoption. Those are long-term drivers of IT spending. And, we expect them to be fairly resilient, but we do have downside risks, which, we mentioned again, China, Ukraine, potential recession, although expectations are diminishing for that. So at a top level, this is a really nice comparison of IT spending versus real GDP growth. IT spending in blue. The dashed lines are a downside scenario, and I think they're a useful context for the potential risks, which everybody seems to be concerned about. Juxtaposing this with the GDP expectations, I think that the outlook is actually that there's some uplift. There's been a lot of focus on the downside, I think, because of Ukraine, because of interest rates, because U.S. potential government stoppages. So there are some short-term, even ongoing real risks that we shouldn't discount. But I think there's a reasonable chance that some of those things won't, things like government stoppage or U.S. recession or things like that those are lower probability factors. And things like Ukraine, while they represent a significant risk, it doesn't seem imminent that they would get significantly worse. And so anyway, I think that's why we have a more probable scenario, which is relatively optimistic in this case. Okay, so that's the broader global macro environment. If we focus in on the NADT IT revenue, North America Distribution Tracker IT revenue trends, this is also, I think, a really nice slide. It sums up themes that we just talked about, we've talked about in past calls, and we'll see kind of details of in the next several slides. But this is each of the major categories that we're covering, year-to-date growth by year. And so we start on the left, pre-pandemic growth in all categories, and particularly on personal computing and software. 2020 started the pandemic. We had some growth across categories. 21 and 22, we had a rebound with real strength in AV and consumer electronics, as well as personal computing. And now we get to 2023, and it's precisely those categories, AV and consumer electronics and personal computings, that have receded the most. So, we just refreshed the installed base. A lot of new buyers came into the market, and now we're seeing those buyers cool off, inventory being reset, supply chain normalizing, and that has impacted those categories pretty substantially. But we see infrastructure in orange, as well as services and software in blue and green, remain positive, and the overall downside is not that large. So it is, anyway, I think that's a really nice summary. As we go into the weekly results for NADT, you can see that we've got, still a lot of volatility on the weekly trends on the left. The trend line in dashed yellow is slowly improving, and we've got less volatility over the past year, almost 2 years, really, year and a half, than we had previously. And then we have, I guess, one other feature that I wanted to point out here is we have easier trends going forward. So while the trend line is still below zero and gradually ticking up, if we look at the history of the trend line, we can see that a year or so ago, this is week 30 was the peak week 31 is the peak circled in red in 2022. And then we have exactly a year later, essentially week 30 in 2023, that's the corresponding low. So if you look at the 2022 growth rates that are following that period, they get easier and easier, and that should make a nice base for us to grow against. The rolling 4-week trend is pretty similar. It's just smoother. I think it's, as I've described in the past, I think still quite useful to see that. It gives you a bigger picture of the impact of past disruptions and what the real macro trend is. So I'll just touch on that quickly on other slides as well. Year-to-date revenue remains down 7% year-to-date, which is still above everything except for 2022. So in a total spending environment, I think that's still quite positive. We did have a slowdown, so it's not all smooth trending. And I've favored these polynomial lines because they give a real clear view of kind of what the macro trend is. But when you're looking certainly week by week, but even rolling 4 weeks categories, you can see there's a fair amount of volatility there. We did have a decline of more than 20% in 7 weeks, in the past 7 weeks, but that more recently dropped to about 7%, which was the overall trend. All right, the 2-year view also is a good way for looking at the macro trend. I think theme that I'll point out this time around is that we seem to be getting past a lot of the pandemic disruptions, and these are normalizing. So you can see a lot of volatility in the weekly trend, much less in the 4-week rolling view in the middle, and the dashed trend line really is quite smooth. So we did have a little dip in the middle of the year, but we're really overall, we're positive right now, and overall positive trend, which means that the setback in 2023 is less than the gains that we saw in 2022. And I would argue in the big picture, that's not such a big setback. So anyway, same thing for the two-year view. The general theme, as I've been saying, is stabilizing growth, diminishing impact from pandemic disruptions, as inflation and geopolitics tend to dominate the macro environment. Okay, this is North America, including Canada, and the US, of course, is a much larger market. You can see in blue, the US, and red is the North America total, are quite aligned. Canada has tipped down in the past couple of quarters pretty substantially. And even in the rolling 4-week view, you can still see a downward trend. As I showed you last time as well, that's the Canada cycle is highly correlated with the exchange rate on a 2-quarter lag. So this dashed red line now shows that exchange rate superimposed on a longer time frame, so you can see the ups and downs of Canada. And then on the right-hand side, you can see the 2-year view of that, which I think does a really nice job of showing kind of where the macro trend is without as much impact of these shorter-term exchange rate fluctuations. So in that view, Canada, the right-hand chart, Canada in orange is clearly picking up and actually pulling ahead of the US in the recent trend, as is the exchange rate trend turning in their favor. Product category wise, so this is each of the top 5 categories of technology, and the main thing again to point out really is the difference between consumer devices, which are in the dashed lines, They continue to pull down results, although you can see the blue and yellow dashed lines have turned up. So those are the larger PC and AV consumer electronics lines. And then the solid lines, which are the software services and infrastructure, remain quite positive. So they're pulling things up. We did see infrastructure hardware, the orange line, take a turn down. I would argue that that's visually exaggerated in this view. So I guess just some detail behind that. So, when you start with very volatile weekly data, you have, as you've seen in the previous charts, quite a lot of variation. So the trend lines will basically smooth, find the trend, the macro view through those trends. So growth for individual periods, of course, will be above and below trend. Well, so for the hardware, you can see here, week 21 to 26 for infrastructure hardware averaged positive 35% growth. And the last 4 or 5 weeks were all in double-digit positive growth. So we did have sprinkled in between in the beginning of the year and sort of between around April, May, and then again more recently, I think June, July, we had some negative numbers for that growth, but relatively fewer and relatively less decline. And so anyway, they're creating this trend line which starts to turn down, but I think if we give it another, I don't know, month or two, that's going to even out. We'll see some better results. On the 2-year view, we can also see, similar trends, of course. AV and CE is the only one that remained below zero. PCs and even others in gray, which I hadn't previously announced or called out, are above zero. Software and services look fairly stable, just below 10%. We do still see that slowdown in infrastructure in orange. Okay, software has been one of the stronger categories. The dominant category in our classification is systems infrastructure software in dashed blue. So that's really driving the trends. It did have a low in April, but is ticking up. Platform software, the ADD line in yellow, is recovering and growth past 20%, so quite solid. And that, unfortunately, is the smallest of the categories. Spending on applications in gray has turned down, but the recent months, August and September, the decline was just about 10%, so noticeably smaller. And then other software, which is actually the second largest category overall, has really taken off, and so that's picking up the results in the last couple of months. On a 2-year view, the main thing to call out is that systems infrastructure software, the dashed blue line, continues to slow, bringing down the other categories. Otherwise, it looks, fairly stable. We do have an uptick in applications, and of course in the others category in orange, which is really helping to pull things up. In services, we have several categories that are a bit more evenly distributed in terms of revenue, as you can see on the left-hand chart. The red line representing overall spending is trending up again, approaching 10% from we had a mid-year low. Other services, the blue dashed line, is approaching 30%, so really solid kind of growth. Again, extended services in orange, the orange line again, which is extended services in this view, ticked up. So, following that trend. And then, warranties in solid blue is leading at the top. That's our smallest category. I didn't write a bullet. I should have, looks like, for other support services in gray, which is a mid-sized category and trending down. But here we are. If we extend one more, you can see that that 2-year trend, even on the gray line, is stabilizing. The yellow platform software is the weakest, but we have pretty solid growth overall in red, still at near 10%, and with the warranties leading growth at the top. Okay, and then wrapping up this overview with PCs, the notebook category in dashed blue is clearly dominant. You can really see the slide from peak pandemic replacement on the left-hand chart. Actually, in both charts, it's pretty visible. We did have some stabilization in the past couple of months. I think we're getting towards a stable market. But in terms of year-on-year growth, it's still quite down a lot. So that trend is minus almost 25% there. Okay. So having said that, year-to-date revenue for notebooks is just around 5% below 2000 levels. So, you know, if you're basing your trend off of the pandemic, that still allows for quite a lot of pandemic growth, which of course we saw, and suggests that maybe we'll be coming in near pre-pandemic levels as a baseline. All right, all the other categories under the PC category have turned up. They're much slower volumes in comparison, but going in the right direction. So again, here, in this case, all of the major categories, including, and maybe most importantly, notebooks, have turned up, reflecting the stabilization. And others, the solid blue line that's taking a downturn here is the smallest category, including thin clients and point of sale systems, has taken a little bit of a dip. I think it's a little bit exaggerated, like the other trend that I mentioned, but it does reflect a little bit of slowdown in the commercial side, particularly around retail, as an example, where you'd have POS systems. Okay, so that's a summary of the NADT results. Let me pass the mic to Susan, who's going to talk about as a service trends and opportunities. Susan?
Great, thanks, Loren. So as way of background, I'm going to share with you a lot of data that IDC has been looking at to understand like buyer behavior and what's driving as a service trends and adoptions. So I'm going to focus on what I think are the top 3 trends and provide you some context for that data. Do you want to go to the first slide? So this is what we're going to look at today in terms of what I see driving as a service adoption going forward. So Gen AI adoption, which I think, you know, is pretty much the hottest topic that we're hearing about in the IT space today. We're going to talk about sustainability and circularity and why organizations are looking at as a service models to help them with this. One of the top concerns in the market is about IT talent skills and shortages. So this is another way that we see organizations embracing as a service models to help them with that. We're also going to talk about how partners are helping to expand this space. And I think that's an important topic to underscore in terms of how they're going to really drive the market growth in this space. And then just some guidance to sum it up. So first slide. So these are some of the macroeconomic trends, similar to what Loren showed you about what's happening. We do a lot of these surveys every quarter and every month to get a good idea of what's driving IT buyer demand and the behaviors. So when we ask them about which of the following risk factors related to your technology strategies and budgets for 2023, what concerns you the most? You can see that the top 3 factors when we asked them this in May were inflation, recession, and staffing and labor. And I'm pointing to that one because I'm going to show you how that correlates to the demand for as a service models. And then we asked them in a survey we conducted in June, is another worldwide survey, about what are your greatest concerns regarding your organization's overall digital infrastructure strategy and how it helps you achieve top business outcomes. So probably not a surprise, but one of the top concerns that almost every IT buyer has and every organization when they're looking at their ecosystem and infrastructure is always about security. So whether it's rising cyber threats, it's always tied fundamentally to security. Additionally, the cost structure. So what's happening is they continue to see their budgets for digital infrastructure are continue to go up, and it's very hard to keep ahead of that. So we see a lot of comments about technical debt, and really trying to support their infrastructure has become a challenge. And so then you can see the tide to operations and staffing challenges continues to be another driver, and data becoming more distributed and harder to manage consistently. So if you think about these themes, I'm going to start to show you how as a service models can really help organizations think about another alternative instead of just always acquiring your infrastructure. So we look at what criteria are the most important when it comes to where you want to deploy your workloads. So if you think about most organizations today, they're very diverse in terms of they have a ecosystem that consists of some data that they have on-prem. They also have workloads that they're running at the edge, as well as sometimes in a colo or within a public cloud. So that correlation and really thinking about the complexity of managing an infrastructure is one of the reasons why we continue to see organizations look at new offerings like as a service. So part of that, we talked about already that resiliency and security are top costs, but scalability, speed of deployment, but this part about access to advanced technologies and services, vendor provided infrastructure, lifecycle support and refresh, they're really starting to embrace that and consumption models because they're looking for help. So when I talk to you about one of the key trends that we're seeing already is that IT staff shortage in talent, leveraging as a service models enables them to get access to some of that talent that they can't hire on site or they can't keep up with from a budget perspective. So we asked them in this same study from June of this year, how important is a shift to as a service for your future IT strategy, including consumption models and remote support? You can see that collectively 78% either strongly agreed or somewhat agree with this statement. So it already gives you the market forecast in terms of outlook. We already see that the good thing is most organizations really understand what these strategies are and what these models are. They know this is another way for them to work with a provider to help them manage their IT infrastructure. So we're seeing very strong correlation in terms of market expectation and what the demand cycle is. And that really shapes our futurescapes. So we do a lot of predictions at IDC. You'll see them this month. We've already started doing a lot of our teleconferences where we start to talk about what we think will be really the outlook and predictions that are going to shape the market over the next few years. And going forward I was part of the infrastructure team that looked at as a service models, and we're expecting by 2027 that 80% of IT buyers are going to really start to leverage these types of models to help them. And a lot of it is a direct result of IT staff shortages, cost, security concerns, and really focusing on reducing the complexity of their ecosystem and managing outcomes instead of managing their infrastructure. So let's talk about when I said on the agenda that what I see as some of the top market opportunities they're going to be helping drive buyer interest in as a service models. So Gen AI is first. So when we look at what's happening in this space, you can see on the left-hand side worldwide, when we asked, think about your spending levels, what are you going to be investing in? You can see that whether it's Gen AI, interpretive AI, or predictive AI, organizations are already embracing these models and investing in this space. We've already broken out for you by North America, Western Europe, and AP. But we're seeing that respondents are really already allocating funds to this space because they realize that this is going to be a seismic shift in the IT space, and they want to get ahead of that and start investing as soon as possible. So we asked them about, okay, so for Gen AI, which is the area that I'm looking at because I see that as one of the first areas that we're seeing a lot of investment. So we asked about what's the top barriers to using Gen AI in your organization. So probably not a surprise, but security was their top concern. And security and privacy, and that's really about protecting your data, right? That is, I think for any organization that's already started to explore this space, that is the crucial metric that they're all interested in. They're setting up training, they want to have barriers and guardrails to protect their data. Now, they're also seeing that, finding a partner to work with is difficult. Developing our own models is a challenge. So that's why if you look at what's happening in the space, almost every vendor is already starting to talk about their examples and what they've done already with their own AI training internally and how they can help you adopt Gen AI in your space. But what's interesting is, and I think what may not be getting up above some of the press releases and a lot of the data that we're hearing about, is most organizations right now, because of their concerns about security and privacy, want to keep their Gen AI training and first initiatives on-prem. But what they're very concerned about is they have no idea about what they need in terms of infrastructure capacity and growth, because the expectation is that things are really going to take off. So that's where we see a lot of organizations really starting to take a solid look at as-a-service models as a way to help them with these undetermined growth needs that they might have. But additionally, they're also looking at it from the perspective of a lot of the monitoring that is key to these models, which are built in, a lot of the services and the IT talent is really what's helping them get from, okay, we have this Gen AI project we want to do, but we have no idea who to work with. And now that conversation is really starting to pick up. We're seeing almost every as-a-service provider really start to build models, start to have conversations, train their sales force to how to have a conversation about what we can do to help you that will reduce your risk, Mr. Customer. Organizations right now are saying, we want to engage in this space, but we're really concerned. What can you do to help us? So this is where I've built this chart to talk about, here's the Gen AI needs that most organizations have, and here's the benefits to as a service. But additionally, I want to emphasize that when we've done studies about as a service models, we've talked about a lot of already what's taken place in this space in terms of market growth was the direct sale from the OEM or like the co-location provider. We've already seen a lot of that take place. The next step to really grow the market has been with partners. And frankly, we've seen almost every OEM come out with some type of offering, and some of them have hit and some of them have been a miss. I think HPE, when they came out with their GreenLake offer for partners, they came to the market 4 times before they got the one that stuck. We're seeing Dell, Lenovo, IBM, everyone starting to put programs together and really be a lot more compatible about how they want to go and grow this space. Instead of being combative, they're definitely trying to embrace the partners to help them. But partners, they really need help. And when we did this study last year, we saw that they needed help in training. They needed help identifying targets. They wanted to understand how to simplify the billing process, because what makes things more complex is if a customer is getting multiple contracts from all the different parties that are involved in the solution. Dedicated customer support, really reducing long sales cycles, enable the partner to understand how to have this dialogue and conversation with the right clients. Because what's critical about as a service models is not only are you dealing with IT anymore, sometimes you're dealing with line of business and sometimes you're dealing with the finance team. A lot of times you're dealing with the finance team because they'll make the final decision about whether they want to use CapEx or OpEx budgeting. So these partners need a lot of help from providers, and we're starting to see real strength in the offerings that OEMs are putting together for partners to help them succeed in this space. So when we did this study in 22, we asked them, what actions or triggers is your company using to develop a customer target profile for as-a-service offerings? And the first one is always about new projects. Sometimes it's about contract renewals, sometimes it's about business outcome requirements. There can be a new merger or acquisition, but it's typically about a new project or support contract renewal that really starts the whole conversation about a new as-a-service offering model. But when we asked them what the main challenges your company is facing, we talked about the top challenges were finding the final decision maker, the contract integration to reduce the complexity of these offers, and the long sales cycle are all what they need. And it really does come down to training, support, and targeting. So really helping them target the right prospect for this offer. And I also want to talk to you a little bit about sustainability, circularity, and services. So some of the benefits that we've seen is that organizations, what makes an as a service model really sticky are the services. But additionally, we talked a lot about the monitoring. And monitoring can mean many things, but there's a dashboard built into all these models. And that's providing significant levels of information for different personas within the organization. So we talked about the IT buyer. So the IT buyer now understands from everything about usage. So usage from particular teams in the organization, and they can see how that's allocated to their monthly budgeting and quarterly budgeting. So they really have live feedback about their usage and their costs. And that's really important because it's providing them a lot more visibility than they had before. So additionally, we also see personas like facilities managers, because now they can see everything about power usage. And we talked about everything about Gen AI and what that's going to do in terms of power requirements. The expectation is it's going to really drive server and storage usage, which is going to be, unfortunately, another huge demand on power. And if you're in Western Europe, for instance, power requirements have become almost like a government regulated discussion point, and there's penalties if you're going over or under. And this was happening prior to the Ukraine war, but it just exacerbated the requirement for the metrics. So when we talk about circularity, right? So now you also have your chief sustainability officer, and you have your IT team, and you have procurement, and you also have your line of business are all starting to have goals for the company by 2040, for instance, about how much you're going to cut your emissions. Well, you need that constant monitoring feedback to help you. But what we're finding when we ask companies about, helping you achieve these sustainability and circularity goals, what's your challenge? And the first one was lack of software to manage my supply chain, because I don't understand where my vendors are getting their different assets, and I need more visibility into that. There's a real lack of internal expertise. So this is another area where as a service models can help you. Budgets and ROI, internal resistance, and lack of standards. So collectively across the globe right now, there's a real difference in terms of how governments and regions are responding to sustainability initiatives. I talked about most organizations within Fortune 500 and most global organizations have certain milestones in terms of emissions and predictability they want about what they want to achieve by a certain milestone. Many of them are finding it very challenging. And one of the biggest challenges is that if we look at Western Europe, for instance, those governments are providing a lot of incentives, both carrot and stick, to get organizations to adopt. So for instance, in France right now, their expectation is by next year, if you're a public company or government within France, you have to incorporate some type of recycled or reused equipment in your portfolio. So that is, and there's incentives to do that, but there's also going to be penalties if you don't. In North America, it's more laissez-faire because the government has not been as strenuous about certain regulations and priorities other than like using renewables and green energy. But what we're seeing is that regulatory pressure in terms of complying with your consumers that want better, they want to work with organizations that have better metrics for sustainability. In addition, we're seeing from the SEC and others is that there's stronger penalties and financial fines. So organizations are definitely aware of that and trying to avoid getting in terms of any financial penalties. So we asked them about, when you think about attributes from a technology vendor that has a credible circularity program, what are the most important attributes? So trustworthiness and reputation is number one. Sustainability reporting expertise, because you can see that organizations want to work with someone that had a journey of their own to meet their own sustainability metrics. And they also want to leverage that expertise because they don't have it in-house. So when I talked about how one of the biggest challenges for circularity was that there's a real lack of expertise, that's where they want to leverage that relationship. Anything you can share to help them would be important. But they also want you to understand my industry, because the metrics that I need if I'm in manufacturing are going to be different from someone in healthcare and different from someone in education or government. So they're really looking for knowledge of my industry, share your best practices, and then help me understand the regulatory environment and laws, because they vary so much by the region and country. So here's where we see a real intersect for sustainability and consumption model consumption. So if you think about on the left-hand side, we saw in a study we did a few years ago that 83% of respondents agree that sustainability is one of the most important criteria for their IT buying decisions. We're already seeing sustainability and circularity criteria built into RFPs. So you can see that it's really become a topical issue, and it's very heightened in terms of organizations because they want to work with someone that they know is responsible. So if we think about one of the top business drivers for sustainability are to improve both your operational efficiency, reduce your costs, and improve your brand reputation. And then the third is organizations are selecting vendors and partners with like-minded sustainability goals. As a service can really help you with this. Now, the reason is because asset decommissioning is built into the offer so that financial and regulatory challenge at the end of life is no longer your concern because the customer won't own the asset. The vendor is responsible for how they decommission. And the IT staff are no longer responsible for tracking those assets and managing recycling efforts. I can tell you countless stories of organizations that their end of life policy is to put the equipment in a warehouse or put it in a closet. And that is not a responsible strategy, and it opens you up to a lot of financial and regulatory penalty. And then the trade-ins can be used to offset new equipment costs and improve budget metrics. So the as a service model within that life cycle, they're monitoring your usage. They can extend life cycles, which gives you another way to improve your sustainability metrics on the monitoring. And the end-of-life equipment is often refurbished or recycled, which meets environmental targets and offers financial benefits. And all of that is provided within monitoring in the dashboard. So organizations can then use those metrics that are here and return them to their chief sustainability officer and say, this is the milestones we're hitting because we've adopted this model. And the next. So overall, in terms of guidance, I think it's important for your network to really promote your expertise and how you can help to reduce complexity. We see that customers increasingly want and need to tap into the expertise and portfolio of multiple providers across an ecosystem. So anything you can do to consolidate that information and make it easy to work with all the different partners in the ecosystem will be a benefit. And we're also seeing a significant data focus, and distributors can help with that across all business segments, industries, and technology to deliver actionable insights. Now that data focus piece, if we understand Gen AI, we're going to see a huge data component. So think about all that's going to happen in terms of growth there. There's going to be a huge opportunity to help. And delivering outcomes. So there's growing expectation for technology to deliver business outcomes. And that means that customers are going to increasingly demand complete solutions rather than individual components delivered as a subscription. So that's why we're seeing, when I talked about the partner piece of as a service, there's going to be a lot there that those services are what make those offers sticky. So they need the expertise within that portfolio that can be in that broad ecosystem. And the benefits are that customer management through automation is key to helping partners really incubate and grow their subscription business. So anything you can do to reduce the complexity, promote expertise, and deliver everything within one contract is going to be beneficial to this market growth.
Susan, it's Frank. I have a question. And I don't think you covered this in the context of revenue, but in terms of where we are today, and I agree with everything that you've stated based on discussions I've had with, folks in the industry as to where this is trending. Mm-hmm. But what percentage of the IT delivery today do you think is through a consumption model?
Yeah, so right now I would say, I look at it in three camps, right? Because if you think about it, it's really a buying model. It's a financial source. Instead of either buying it, leasing it, you can do this as a service model. I would say that still the majority is purchase. Yep. But I would say right now for as a service, it's it's between 25 and 30%.
Wow. Okay.
Yeah. And then if you think about, when I think about as a service, I'm also thinking about device as a service, right? So you have everything from client devices that are in this model all the way up to infrastructure.
Yeah, good. I think the point about the consumption model and sustainability and the relationship there, I think that was really significant. We've had a pretty significant sustainability initiative going on at GTDC, and this is information for us that's helpful, very helpful.
Yeah, I mean, it's interesting because, you know, if you take the viewpoint right now where we're already seeing it in RFPs, right? So that's what drives it, because organizations are on the hook to report their own initiatives and what they're doing. So they're looking for expertise and partners to help them with that, whether it's a vendor partner, whether it's a MSP that they work with. There's so many different areas that they really need help. I think if right now, from an industry standpoint, what we're seeing on the OEM side is almost all of them are getting much more aggressive about what they're going to be putting in the market and how they're going to be reporting, because they understand that this is a challenge for organizations right now. You know, and again, there's different pain points. I brought up the example of what's happening in France, but then I also see, you know, Western Europe is very concerned about power consumption and energy. And then, but in North America, we also have those challenges too, in terms of, you know, there's some data center build outs that can't happen because they don't have the power to support it. So it's very important that everyone understand that sustainability means different things. Like there's different metrics they care about, but almost all of them understand that they have to report it to show their milestone goals.
Yeah, absolutely. That's great. And one last question, Loren, to you.
Yeah.
After listening to everything that you know you went through and all the data, I guess the net, you know, sort of feeling that I have is that, you know, we kind of bottomed and we're kind of heading back in a positive direction, hopefully for the rest of 23, and then, you know, 24. Is that, did I take away the right message from that, or was I, did I miss anything?
No, I think that's a pretty good summary. I think maybe another layer is just that the devices, particularly consumer, have been on the slower part of the curve recently. But definitely, yes, the overall spending trend is leveling out, and we've been pulled down by this slowdown in consumer devices, but seems like that's stabilizing. So should be getting better going forward.
That's great. That was great information. Thank you.